So PISCES is trying to address a couple of problems in the private markets or in the UK financial markets in general. And it's one of a string of changes and announcements that have been made recently around making listings more straightforward, attracting more IPOs to the UK. So let's take those problems that it's solving one by one. The first problem is there's been many attempts, and some very good attempts, at developing a secondary market within the private markets. And it's always kind of come up with the same challenge. The main one is that there is an imbalance of risk and reward between the investors and the company. So if you think about the company, they're not receiving the money that's coming out of these secondaries, so they're not raising capital to kind of fund their growth or operations. They do get indirect benefits, which are, for example, increased liquidity of their options, or at least perceived liquidity, increased value of the option scheme, the ability to let employees exit, and therefore increase the impact and the value of things like option schemes and EMI schemes that they may have in place. That may also indirectly increase the valuation that they get at primary rounds and make it easier for them to raise funding because investors see a potential way out. However, those benefits are indirect compared to the very direct risks that the company faces. The main one is valuation volatility. So even if private markets are priced less often than the public markets are, a private business is very precious about their valuation because a down round or even a single overvalued transaction can quite materially hurt the business long term. So if the round is overvalued, then any subsequent events where the valuation corrects are perceived as a down round, even if the previous event was kind of an anomaly. And that's something they'll have to explain and defend, and it will leave a negative mark on their record. And obviously a down round is a down round and something they want to avoid. So the risks for the company are very material. The benefits are kind of indirect. For investors, the benefit is obvious. They get to diversify, they get to join businesses that are not necessarily raising primaries. They can potentially get the stakes at a discount. And if they're existing shareholders, they get to get liquidity out of some of that paper value that they may have been holding on to for a long time. The challenge with historic attempts at a secondaries market is that generally there's been relatively little oversight and regulation, which has given it this atmosphere of kind of the Wild West. And also it's usually been positioned as an investor-led offering. So even if the company has to go through certain governance actions to approve this, this is normally something the investors push for because of the benefit for them. And the uptake and the buy-in from the company is relatively limited. Therefore, the key benefit of PISCES from a company perspective is that it is company-led. So an investor cannot put their shares up for sale on PISCES. It has to be the company that requests to join with an operator. The company has to go through the administrative process, and the company gets to set restrictions on how the events can run. So they can restrict share classes, for example, and they can set price bands as well to restrict that valuation fluctuation, although they do have to disclose how they've come to those values as well. Don't invest unless you're prepared to lose all the money you invest. This is a high-risk investment, and you are unlikely to be protected if something goes wrong. Take 2 minutes to learn more via the link below.